Assalamualaikum guys, welcome back to Sada Education. We know very well that Bank Negara Malaysia have risen the OPR rate by 25 basis point or 1/4% last week. The same for the Feds that has increased interest rate to 5%. What is the implication of this rising interest rate on the economy has been discussed in many ways. My focus today will be looking at the impact on the lending rate. Lending rate, whether we are dealing with Islamic or conventional banking. So this is what we want to see. Based on the report from some of the research houses in Malaysia with regards to who will gain or who will lose from this OPR hike. And based on some of the research here, they are saying that in particular, Alliance Bank Malaysia and Bank Islam are expected to benefit from the OPR hike. And the research unit also cited that Affin Bank and Public Bank will be gaining the least. So what are the issues related to the fact that some banks are in the money, some banks are out of the money. So that is essentially what I'm trying to look into today. But in general, we all know very well that the interest rate or profit rate is the sum of the base rate, which is the OPR plus the spread. But there are some variation based on the latest base reference rate policy, where the bank would have to base the base rate based on the 3-month FD rate. So the 3-month FD rate, can be lower than the OPR. But if the bank is able to put a lower rate than OPR, then the bank loan rate will be more competitive, and many of the customer may flock to the bank to take loan or to take murabaha. But if we were to depend on the OPR, which is maybe higher, much a bit higher than the 3-month FD rate, so then the competition will begin there when banks are putting or using OPR as the base rate. So the OPR is the interest rate that banks charge to one another in the interbank money market. So if the bank do not have enough deposit fund to make loan or to make murabaha, so they are, not they are forced to, but the other option for them is to borrow from the interbank market rate to make loan or to make murabaha. But of course, the loan rate or the profit rate will be much higher because the interbank money market rate is based on the OPR. Whereas bank can also acquire deposit from current account or from saving account, where the rate will be much lower than the OPR. Then the other component of the interest rate is the spread. So the spread will not be affected by the OPR change. It's only the base rate that will be affected by the increase in the OPR. But just to, provide a general overview of the spread is the additional interest rate on loan based on, number one, overhead expenditure, based on the opportunity cost of cash and liquidity reserve requirement, based on the statutory profit margin, and mostly based on the credit standing of the borrowing customer based on the 5C system. So this number 4 has been the main focus of the spread, which is the credit risk premium. So the higher the credit risk, the higher will be the interest rate charged onto the customer. The lower the credit risk, the lower will be the loan rate. So this credit risk will be assessed using the FICO system or using the 5C system. So I will not go into, overhead, opportunity costs, and the rest. So, we can say that the interest rate or the profit rate is highly influenced by the OPR and the credit risk premium. But when it comes to the rising OPR, the loan rate or profit rate will be affected by the base rate. All right. Now, since Alliance Bank and Bank Islam were mentioned to be, the benefactors of this higher OPR, whereas Afin Bank and Public Bank is not in the money. So what is actually the issue here? Now, the issue here is, among other, is the fact that the loan rate or the profit rate is based on the reference rate guideline issued by Bank Negara, where the loan rate will be the sum of the 3-month FD, which is close to the OPR, plus the spread. So if, for example, loan rate 1, we have 3% OPR plus 3% spread, then the loan rate or interest rate will be 6%. Whereas if the bank is to use the rate from the cheaper deposit, because bank acquire deposit from current account and saving account, and the average deposit rate for current and saving is about 1%. Saving, current doesn't give any return. Saving, there are some return. Let's say average is 1%. And the spread, the riskiness of the loan is 3%, and therefore the loan rate can be charged at 4%. But then, the rule allow the bank to charge using the OPR, not the rate from CASA. And thus we see that the bank that is holding a bigger amount of cheap deposit that are coming from current account and saving account, they will be making a higher interest margin, because, if they were to charge the loan rate based on the CASA rate, then they would charge at 4%, but they are allowed to charge based on the 3-month OPR, and therefore charging at 6%, and therefore this bank who are holding a bigger amount of CASA account, they will enjoy a higher interest margin of 2%, right? So cheap deposit are current and saving account. High cost deposit or high cost funds are the FDs and the money market fund. So if banks, are not able to acquire bank are not able to acquire enough current and saving account or CASA, then they will have to depend on the high cost deposit to make loans or to make murabaha. So the interest margin will be low, right? So bank that is holding high concentration of FD will find that their interest margin will be much smaller than banks that have low concentration of FD. So any banks with high amount of CASA, these are the banks who will be enjoying higher interest margin based on the rising OPR. Right? So that is why sometimes we can see that when banks are not competitive enough, they are not innovative enough, so they will depend on FD deposit to make murabaha or to make loan. But some other banks, they have a very good strategy to invite more customer to use current and saving account, and they are able to bring customer in a bigger way, and at the end of the day we will see that these are the banks that will enjoy higher interest margin as the OPR goes up, because they will be charging the loan rate or the profit rate not based on the CASA rate, but based on the OPR, which is higher. Okay guys, I think we can stop here, and I can see you again in the next video. Please don't forget to comment and to subscribe. Assalamualaikum warahmatullahi.